Namaste friends, welcome back to a channel where we decode complex topics into simple, easy to understand pieces. If you're new here, do hit the subscribe button and the notification bell so you don't miss our future videos. Today we are going to break down a banking term you probably must have heard, base rate. But don't worry, we'll make it as easy as a cup of tea. So what is base rate? Well, it is the minimum interest rate set by Reserve Bank of India, below which banks are not allowed to lend to its customers. Consider it like a floor price for loans. It's there to protect the consumers and ensure fair lending practices. Let's simplify this a bit. Suppose you are shopping in a market and there is a rule that no shop can sell apples below 50 rupees per kg to ensure fair trade. That 50 rupees is like the base rate, but for apples. So when you take out a loan, the interest rate which you pay will never be lower than this base rate. The actual rate you get might be higher based on your credit score, loan amount, loan type, and the bank's own policies. But why does it matter to you? Well, when the base rate changes, it can affect the interest rate on all sort of loans, whether it's a home loan, car loan, personal loan, you name it. So there you have it. The base rate is the crucial element of banking, keeping our financial system fair and balanced, and directly impacting the interest rate we pay on the loans. So I hope you found this video helpful. If you did, make sure to give a thumbs up, share it with your friends, and subscribe for more easy explanations. Thank you for watching, and we'll see you in our next video.